All right, welcome to the Learn as You Grow R&D room live. We're going through Tasty Bites series. I found on Tasty Live website there is a ton of information on small accounts, which is exactly what I have. And if you have a small account too and you're wanting to learn to do options, you can tag along with me as I go through each of these in the series. And my plan is personally to go through it here on the channel, to go through it as I can listen to it, and then also whenever I get a chance to actually study it on my own, taking notes just like this as we go along the series. So I've watched a lot of these videos in advance, and there is something good out of every single one of them. This first video is demonstrating the beginning of the Tasty Bites, and this is back, and you can probably see it down here, January 9th, 2013, and they've been doing these Tasty Bites all the way up until now. So there's a lot of good information, a lot of how-to and studies that they've done throughout the years, and we're going to go through as much as we can, go through these videos and see what we can learn from it. I'm going to take screenshots as I do for each video. There might not be anything to take a screenshot of, but at least get notes and follow through with each video here, taking the notes as we go. So I'll go ahead and copy this link so you can have access to it in the live stream. So you can be directed right to the website. And I'm not endorsed by, Tasty Live. I'm just a viewer and a follower, and just want to take us along and see what we can learn here. So without further ado, let's see what the video's got.
Is just the worst. And they should cancel their stuff. Just please shut it all down. I mean, the problem is that people continue to perpetuate all these ridiculous myths and misunderstandings about everything, and shut it down, please. Right. Do us all a favor. They should shut down all of these.
Bad information is much worse than like nothing at all.
Well, it continues these bad myths, and it also just kills the credibility and the integrity of what we do. So yeah, just get rid of it. I mean, it's nice to have lots of other hamburger stores. If you want to sell hamburgers, guys have other hamburger stores around. But you know what? When they really don't use good meat, you don't need them around.
Right.
All right, Tasty Bites. You ready, Bat?
See, when you bring it back to food, like with the water and the napkin and stuff, it's just out of your wheelhouse. When you bring it back to food, you're right there.
I had a bunch of food ones. I just go back for a second, Linda, just the logo for just one quick sec, the R card. I just want to tell people what we're going to do here. Today is just a very short introduction, 15-minute introduction. We got a lot of requests over the last 18 months to talk about, we take some stuff for granted. I understand that. We have to. We want to keep the show at a certain level. We are not investor education. We are network financial media, and we need to keep the show moving, and we also need to keep the show very real. A lot of times we take certain things for granted. That's understanding of certain ideas, products, integration, all this kind of stuff. We also take capital for granted because we may trade with more capital than some of the listeners, and so it's not always fair. We've done a lot of research on our listeners, and we found that here's the amazing thing. The average TastyTrade listener has a lot more money than the rest of the industry. Not only do they trade a lot more, they have a lot more money. Our listeners are out there at a whole different level. They have I can't say they are, I can say they're smarter financially. Their financial literacy rates are off the charts. The amount of capital they have is really on the high end of anything I've ever seen before.
Listen, we only know that from the emails we get and the type of questions that we're getting. If you had a really small account, you wouldn't be asking us type of questions.
We also do a lot of work, and this is all just internal, just to understand, make sure who we're talking to. But there's a lot of people that also they don't slip through the cracks. They're just getting involved, and you know what? They want to just do it on a small level. We're not big fans of the whole virtual trading, paper trading, things like that. We love to do it real, but there are a lot of smaller accounts, and we have, to this point, we haven't really been fair with respect to our time. So we thought, okay, this year we introduced a bunch of new things. One of them's called Tasty Bites. Tasty Bites is just going to be, you and I did a show from Taste of Chicago. And there's like hundreds of different types of food at Taste of Chicago. But at every stand, you don't have to buy the whole thing. You can just buy a bite.
Sure.
So we said, you know what? That's kind of cool. You could just a tasting bite. You know what? We're going to put out a tasting menu. And so we're going to talk about smaller accounts. We're going to talk about games. I'm doing it with my daughter now too. But that's more of an introduction to the space.
Introduction.
Yes, that's a family introduction to the space. This is more strategic. So Tasty Bites will be, hey, what can I do with a smaller amount of capital? Okay, now let's go, Linda. So, Tasty Bites, ideas for trading smaller accounts, ideas for getting started, ideas for trading smaller accounts. Just today we focus on, we don't get to the strategies yet. We just we may mention them, but today we need to understand the limitations and define what it's all about, all right? If we have time, we'll get to some primary strategies. Good. So, first, let's understand the limitations. even if you want to open the smallest of all accounts in order to trade derivative products. And again, it's not that you have to trade derivatives. It's that we don't understand how anybody can improve their probability of success without reducing cost basis.
Correct.
Okay, the only way to improve over 50-50, and you saw this yesterday, how the numbers are staggering with respect to ultimately to probability of success. The only way to improve your probability of success is to use certain derivative products. Okay, and I don't care what anybody says, because you could say, hey, my way is through this, my way is through this. The only factual way in a random environment is to use some product that has there's a mathematical equation that gets you to the end of that logic chain. So account net lick must be over $2,000 to maintain margin status. That's not a TD rule or TOS rule. That is an industry rule. Okay, must have over $2,000 to have a margin account. The reason you need a margin account is to be able to do a lot of the strategies we talk about. Sometimes you can do it, there are different types of cash accounts where you can do some very basic stuff. But for the most part, when you get strategic, you have to have the ability to, you have to be able to do it. Mm-hmm. You're going into a casino that lets you play all the games, rather than a casino that only lets you play certain games.
Correct.
Okay, and the difference between this industry and a casino is there are certain places in the casino where you have minimums. There's not really places in this where you have the same kind of minimum. Net lick, industry slang for net liquidating value. It's the market total value of your account. So your net lick must exceed $2,000 or be $2,000 or greater. Go back to the other page, please. Good. So that's just to have a margin status. Most brokerage firms, the way that they interact with FINRA, which is their regulatory body, the way that they interact with all of their various regulators, most require that the net lick of the accounts must stay over $5,000 to sell naked calls. Okay, and the reason they do this is because this is just a reflection of a term they call suitability. Now, I'm going to argue, okay, and I'm going to argue this forever, that what some people consider to be risk and complexity actually significantly improves your probability of success. So there's not necessarily a relationship between complexity and risk or complexity and probability of success, but there is a relationship between suitability and capital. So most firms, and that's because this is a regulatory requirement, require $5,000 to sell naked calls. In some cases, naked puts do not require the same thing. And the reason for that is because naked calls have theoretically unlimited upside risk, but naked puts, stock can only go to zero. So if it's cash secured, blah, blah, blah.
You can put a number around it and come up with an equation on your risk.
Also, because of the way the markets were kind of flowing freely in the late 90s, they came up with this rule called this pattern day trading rule. And I hate this rule because I think it is counter effective. In other words, I think it has led to, I think it sends the wrong message and limits the opportunity that smaller investors have to be successful. It actually does exactly what it's designed not to do. Here's what happened. In the late 90s, a lot of people decided, hey, we're going to be day traders. And that is not a great way. I agree. It's very difficult to make money as a day trader. Mm-hmm. And most of the people that tried to make money day trading stocks at the time, just because we were in a bull market.
And it ended with .com was going twofold every day.
It started off great. It ended horribly. Mm-hmm. Most of these people ended up, if you started with $100, you might have at one point.
What they're doing here is basically setting up as if they were in a small account. They kind of deviate from that and do more of a study based, but here in these first few episodes, they go through and give kind of some examples of what they plan to do with this small account, and then they actually let the data speak. So pretty interesting how it evolves, but it's neat to see how their thought pattern is. If someone like Tom had a small account, even though it's back in 2013, if someone like Tom had a small account then, what would his options be? What would he choose as a strategy? How would he handle that small account? So keep that in mind when you're watching.
Got it to 1,000, but you ended up with zero. Right. And so in order to combat that going forward, they created this thing called pattern day trading rules, which essentially say that if your account value, net liquidating value, is under $25,000, you can't trade the same underlying in and out more than 3 times a week. That's why you got a counter on your platform. Now, if you have over $25,000,
4 more day trades in 5 business days. Okay. 4 more day trades, yes.
So that's right. You can't get over the 3. Once you get to 4, you're done.
Correct.
Okay. And so that's in and out in the same underlying. Well, that created all these crazy other problems because all of a sudden, if you didn't have enough money, you couldn't really even create the right number of occurrences.
Correct.
So again, I think it is a detriment. I think it was put in place with good intentions. It actually unfolded for all the wrong for all the wrong reasons. Now, that said, it still exists and doesn't look like it's going to be changed anytime soon. So those are 3 of the areas that you just have to be aware of in a smaller account. Again, net lick must stay over $2,000. Account net lick must be over $5,000 to sell naked calls, and accounts under $25,000 are subject to pattern day trading rules.
That's a FINRA rule. It's not brokerage for me.
Right, sure. Okay, let's go to the next slide. Okay, so what we're going to do here, and this is just very limited today. Okay, we're not going to go off and crazy. We're going to save this for the following weeks and things like this. We're going to understand the primary approach and the primary strategies for smaller accounts. They are much more affected by defined risk approach. And let's understand what happens in a defined risk approach. When you're forced to use defined risk as your primary vehicle, okay, that will limit your probability of success to a number that is lower than that people have with more capital. You have to know that, because you got to know what you're up against. Okay, there's this old saying that money goes to money. Well, to a certain extent, in this particular business, there's a linear portion of that equation, which is very fair. There are certain things you can do with more capital that you cannot do. There's certain things you can do with more capital that dramatically improve your probability of success. When you first started trading, you started with $5,000.
That's correct in my account.
Right, but your haircut at the time, which you may or may not have even realized,
was greater.
Was over $100,000.
Correct.
Meaning that because you were a member of an exchange with $5,000, you could trade well over $100,000 worth of capital.
Correct.
And that was overnight. Intraday, you could do whatever you want.
Pretty much, yes.
Okay.
Because it was before 87.
Right. So
1987.
So that's when we started the business, and we were able to start with a lot less money, is because we had leverage of 20 to 1 plus, and intraday we had almost unlimited leverage.
Correct.
Now, there was a lot of things that are scary about that looking back now, but at the time, who knew?
Correct.
And you were paying a lot of commissions.
A lot of commissions.
Okay,
In fact, I think our commissions were higher than what they are now as
way
a
higher.
retail investor.
Kidding. When I first got this business, my
$3 a contract?
No, it wasn't that high, but it was high. Anyway, well, my point here is that as a small individual investor, I have this theory that you may never trade a stock, or it may be a long, long time before you trade a stock, but you have to still get to a statistical probability of success that exceeds 50-50. So you're going to take a defined risk approach, because you have to with a small amount of capital.
Yep.
Second thing is you're going to learn strategic diversification, which is different than strategic diversification on a $100,000 account or on a $1 million account. Strategic diversification limits you because you can't really find those naked strangles. You can't really find those naked calls or those ratio spreads. So your strategic diversification is very different than it would be on a larger account. Then your capital per trade comes into play, because you have to deliver number of occurrences. You have to build on this as a learning curve, but you can't look at this as pure education. Like, you can't take a small account and think, you know what, I'm willing to risk this whole thing, because it's probably everything you have.
Correct.
So I look at this as a defined risk approach, and understanding that your probability of success is going to be a little bit less than somebody else that's out there, or somebody else that we're talking to, because again, it's not linear. And the complexity and the suitability issues, okay, come into play with what you can and can't do.
It kind of puts you a little bit behind the 8 ball.
It makes it more challenging.
Yeah.
But anytime you try to do that, listen, if you're bootstrapping a business with $5,000, it's hard. If you're bootstrapping a business with $5 million, it's a little bit easier.
Correct.
Okay. Strategic.
And that's what this is, right? I mean, it is starting a business. Correct.
Like, we couldn't have bootstrapped TastyTrade with a small amount of money.
It would have failed.
It would have failed.
Correct.
Now, I believe that in this business, in investing and trading, you can bootstrap it with a small amount of money. It takes some time. There's no way you're going to turn 2,500 into 25 million. Okay, can you turn 2,500 into 3,500? Yeah. Can you turn 2,500 into 5,000? You may be able to. Can you at least learn so that as you acquire more wealth through life? Yeah.
Can you turn 5,000 to 25,000 and then ramp it up from there? Yeah, you absolutely can. It's going to take time.
It's going to take a lot of time.
Yep.
It's a giant challenge. I mean, even if you were invested in some monster investments over time, you'd still, to even get a 200 or 300 or 400% return over a 4 or 5 year period is.
Well, I read articles about people that take $100,000 and make it into $11 million.
Stop. It is a very rare occurrence. Okay, what we're really trying to do here, let's be realistic. Okay, if you start with $2,500, it's a home run if you get to 3,500. Okay, if you start with 2,500 and you get to 5,000, you hit it out of the park 6 times in a row. I mean, this is a challenge just to get up. But the learning process is so valuable that as you create wealth throughout life, just all the high probability aspect of it. I was here yesterday with some.
So this really helps me to realize that, you know, I'm doing this to learn with my small account, not to try to hit a home run, right? Not trying to make millions of dollars. Of course, the way that you can get by with that is continually adding part of your income, or some form of, you know, being able to inject your account with more money over time helps this process. But really trading small, getting a small strategy together, even using a small portion of my small account to get this going, is a big help in just getting the mindset of, I'm wanting to learn a strategy and not trying to make a huge amount of money in a small amount of time. Really just focusing in on that. I'm here to learn something. I might lose money while I'm doing it. I might not, I might break even, or I might lose my money in commissions, whatever. I'm going to get a strategy that's going to help me to learn and get my feet off the ground and not lose half my account, which is exactly what happened to me, right? I was taking on too much risk. So what he's saying here really makes me think about that. I'm not here to hit home run. I'm not here to turn $2,500 into $1 million in 4 years. I'm here to learn. And if I end up making money through that process, then that's the only thing that's in the way is scaling it, right? And getting more money to inject into it and then grow it from there. So I really like what he's saying there.
And I was talking about investment in his company, just as an angel investor. And we were talking about differentiation, and we were talking about probability of success. And I explained, and he understood the whole concept of number of occurrences. And we took it from a trading side to a business discussion, nothing to do with trading. I'm going to suggest to people that everybody watches TastyTrade, whatever your business is, your ability to articulate a business model is going to be so much stronger because you understand the logic chain so in a way that nobody else does. Right. Capital per trade, Tony, is the challenge, because when you're limited on your capital per trade, and you know our number of occurrences thing here, we don't believe you can be successful even in a small account unless you can create the right number of occurrences. So what TastyBites is going to be about is, hey, how can I do a trade for $70, $100? I know I have to create the right number of occurrences. Correct. How do I negotiate the commission level I need? How do I do all this kind of stuff? Okay, how do I get where I need to be? What type of technology do I have on? What type of strategies do I need to have? And it's going to be a year-long thing. I think people are going to love it.
I'm sure they will.
And it will let us throw out a wider net and stuff like that. So right now it is scheduled for Wednesday mornings at 8 o'clock. If we get the feedback that we want over time, okay, we'll expand it to maybe even to twice a week. All right. 8:18, we come back with opening bell in
90 seconds.
Beautiful.
You're listening to Tasty only on TastyTrade Network.
There was
Okay, so not sure if you can see my notes here, but I basically copied down what was on the slide, which I won't do that every time, but I thought these were kind of interesting. But just giving some guidance on, the account size, what you need to maintain margin. The strategies that he has in mind for the small account is a defined risk strategy. And the way that I lost half of my account is I was doing undefined risk strategies on very large future instruments. And I quickly found out that futures instruments are all very large instruments when it comes to options. So using defined risk for small account, high probability trades, like you said, don't aim for home runs, be diversified strategically. And so we'll find out later, in the videos we watch, what exactly that means. And then the amount of capital that we're going to allocate per trade, because it's very important that we go small with many occurrences doing a small account. And so that's where he adds the point of number of occurrences. So having a high number of trades to prove how your strategy is working. Is it working or not? So that's very important. And I've started to keep track of my strategies on a spreadsheet to see how each trade goes and what's my probability of success on these strategies, to test them out and tweak them as I need to see what's working and not. So I've got a 0 days to expiration strategy I'm doing. I've got a credit spread strategy. And then I think I'm going to do just a regular iron condor strategy. So anything, and I've heard of Jade Lizard as well. So as I learn different strategies, I want to try to record that, and I'll take you along with me on these strategies. And I'm thinking about doing an update for every strategy on a certain day of the week. So more to come on that, but a very interesting video for the first one there. And then we'll take a look at the next one here. If it lets me. I was hoping I didn't have to do this. I'll keep this on the tab so we can just pull up the video faster. But yeah, so this is these TastyBites. What they basically turn into is like a market measure that they do. for a small account. So it makes a really big, it applies more to people with small accounts like me. And if you have a small account, or you're trading like a small account because you're new with options, this is very useful information. And so I was looking at Tasty Live from YouTube, and they actually have, it's pretty much, I think of it like a YouTube, but it's their own platform that they have all their videos on. So extremely useful. And I recommend anybody that's wanting to learn options or go through these on their own to check out the link. That was the last video, the link that I've got in the chat, and get started on watching these videos on your own. You know, you don't have to have me with you. Definitely not. But just want to be able to, as we go through these, you know, different things that we learn, we can share and kind of get some insights and thoughts on all these different points. So you can see they go back pretty far. So make that go by faster. We're almost there. So because I'm doing it from the oldest to the newest, it's there we go. Oh, that's not what I wanted. Sorry, guys. Well, go back on this one again and see what happens. Yeah, I think my laptop is it's getting overworked from the live stream. Yeah, so what I'll probably do next time is go ahead and have these videos loaded and ready. Okay. And yeah, we could just pick any random video, but I really want to go through the series. And I think as we see it progress and as they follow through on each week, we start seeing that how they add to, well, I did it again, how they add to their series there. So it really improves as time goes on, and you tend to get more and more of what they're thinking, you know, because they decide what episodes they're going to be doing, and so it's really helpful to go in sequence there. And they go further into strategies too for small accounts. So some of them they compare like an iron condor against a strangle. They have the jade lizards that I was talking about earlier. You know, so just looking at how you can be more efficient with your capital, different strategies like that. The one that I watched about the jade lizard was that basically what you could do is just continue doing your wheel strategy, sell a put for your credit, and then you could sell, depending on how the prices are, you could sell a call spread above that put enough to where it would cover the premium. So basically you're, I don't know exactly how it works, but you basically cover, if it's wide, if your credit is wider than that, then you basically don't lose if it goes up. So, but we'll see that video. Well, there'll be more details on that. But I thought that was really interesting, and the jade lizard is probably something you can add to your wheel strategy if the conditions are right. So let's look at part 2 here.
Thomas, we're back, my friend. Tasty Bites.
All right.
Go from a Girl Scout cookie to a Tasty Bite.
That was pretty funny. That was a good first hour so far today. Hey, you know, it's something I was thinking of.
You were thinking again?
Yeah, I was thinking.
What did I tell you about that?
Sorry about that. Hey,
I was thinking maybe you could prepare for the segment before we get to it.
No, I'm all good, man. I got so much stuff going on here. So just before we get started on Tasty Bites, there was this is the world of, we're in the era of kind of everything social. Like I actually don't want you to, I don't want you to wear a camera. I actually don't even want you to be my friend on Facebook. You know what I mean? Like
I don't have a Facebook account, so you're safe.
I mean, if you did.
You know why? You know why?
Why?
Because I'm afraid I'd request you as a friend and you wouldn't friend me. Now, how's that going to look to everybody out there who's watching the show?
I don't really take any friend anymore because I'm just done.
You don't take any more?
I just don't.
You're closed?
No.
You have a closed book right now, but when you have a reservation that's open, you'll take one. So the only way that you can become a Tom Sosno friend on Facebook is if somebody in your list passes on or sends a naked picture, right? Is that how it works?
One of my oldest friends sends me a friend request. This is like about 4 years ago.
And you still have it sitting in your inbox or something?
2 years later, I checked on him and let him and became friend.
They tell you what to do with it?
He wrote me back. He said, "F you, ass blank." Okay,
Yeah.
He was like,
I don't blame him.
So anyway, that's I don't do it on purpose. I just don't really.
No, you're done now. You're all booked up.
No,
No, you're all booked up. Yeah, no.
I booked for 2014, 2013. You know, booked for 2013. Have a few openings 2014. No, that's not it at all. But it's just so funny. Like I don't want to know any. Like my whole thing with TastyTrade is that I don't want to be social in the sense that I want TastyTrade to be special. I don't want it to be like a social enterprise. Remember how I ripped on Twitter when we first started TastyTrade?
Yes.
I ripped on Twitter because...
You can follow me on Twitter, Tony_Batista. That's 3 T's, Battista.
I ripped on Twitter because every single person you talk to says, well, if you want to grow your business, you have to get on Twitter and you have to do all this. I'm like, no, you don't. You know what? No, you don't. No, you don't have to do that at all. And I was right. I hate to say it, I was right. If you want to get on TastyTrade, you have to go to TastyTrade.com.
I understand.
I'm a huge... I loved the fact that, like, you know, certain firms have always maintained that kind of special quality, and I want to be one of those. And if you want to watch TastyTrade, you got to go to TastyTrade.com. I mean, we do license the video stream to TD because I want to stick in there because a lot of our members trade on Thinkorswim, and I don't want you to have to always go back and forth, so you can see it right through the Thinkorswim platform. But if you want to go to TastyTrade, you want everything, you got to go to TastyTrade.com. People write me all the time. They go, "Why aren't you guys on some network? Why aren't you on Sirius Radio? Why haven't you licensed?" I don't want to.
Sure.
I don't want to. We've been approached by a million different radio stations and TV stations, and I don't want to commercialize it.
Cable.
And it's so funny, too, that they set it up that way this early on because I was watching them on YouTube. They don't have all of their stuff as organized on YouTube. You know, I think it might be newer to them putting it on YouTube, but they have it all organized right here, right on their website. I mean, it's really, to me, it's changed. You know, I don't even look at them on YouTube much anymore, unless it's just something new on their YouTube. But I'm looking at their stuff here on their website, so it's set up pretty nicely. There's no ads. They really have set themselves apart, having their own website.
Cable, everything. Like okay, someday we'll see if we have to, you know, sponsor something because we have to pay the bills or whatever it is. But I don't want to lose control over. I don't want somebody running a Subway ad.
I'm not going to get a Facebook account, but if I did, would you friend me? Would you make an exception?
No, I have enough of you. 12, 13 hours a day. Like, I don't need to talk to you.
No, come on. Not for the shtick for the show.
This is not part of the shtick.
You'd Facebook me, friend me, wouldn't you?
No.
Come on.
No.
Don't make me do it.
I don't want you in my little circle. No. Okay. Tasty Bites, ready?
I don't know. I'm a little hurt right now.
Don't be sad.
I'm a little hurt.
Linda,
I'm sensitive.
Let's fire this up. Let's remember what Tasty Bites is. This is for account sizes that are anywhere from $2,500 to $25,000. Underneath that pattern day trading, $25,000 number, and much more, and more so designed for trading accounts that are much smaller. Let's call it 2,500, 5,000, 10,000, whatever it is. I'm not trying to put a specific number on it because once it's under 25,000, you have certain limitations. It has to be over 2,000 because you have to have a margin account to do. So it's somewhere between 2,000, 2,500, and 25,000. I don't care what the number is. The purpose of Tasty Bites is to talk about strategies that are not day trading strategies. It's to talk about how to manage, how to appropriately manage, and how to design a creative methodology and create a strategic approach on smaller account sizes. And lots and lots of people have this, including my own kids. Okay. All right. Number one. And again, this is to add on to what we did last week. We're going to do Tasty Bites on every Wednesday, and I'll decide later on if I want to do more of these, like twice a week. But right now, once a week. All right. Number one, we have to create and the next week we'll start getting to actual strategies. Number one, we have to create a universe of liquid single point strike stocks, ETFs, and inverse ETFs. Now, the reason for this is because as glorious as it may sound, okay, one of the limitations of smaller accounts are the products that you trade. And it's not, I don't want to say, hey, you know what, you can't do this, you can't do that, you can't do this type of thing. But one of the things that makes it a lot easier is you don't have to spend a lot of time searching for things that aren't in your wheelhouse. Okay? I mean, if you have a limited amount of capital, it's great to go to the Ferrari dealer, all right, and walk around the showroom. But the reality is you're not going to buy one of those cars.
No, it's not. You would never do that.
I would never do it because I don't care about cars.
See, this is not fun.
If you're into cars. Okay, if you're into cars. Okay. I'll give a more example for you. Like you're walking down the street and there's an Italian bakery and there's a lot of cannolis.
Thank you.
Okay.
I can always have a nice sfigadelle or something like
Right,
that.
a little Italian pastry shop. You didn't think I was going there,
Right,
did
no,
you?
I didn't. Thank God. You do like me.
Okay. So my point is, one of the first things I tell people, and I've talked to like my daughter, I've talked to my son about this, I've talked to their friends about this, and I've talked to lots of people that are just getting started. Hey, create a universe. We put on the Toss platform, we put kind of our sample TastyTrade watch list, but you can create a universe of single point strike underlyings that are liquid and that have enough activity so that you can create strategies out of them. When I teach a class in Chicago, and when I teach that class, sometimes I talk about, hey, defining a list. Maybe it's 15 stocks, maybe it's 10, maybe it's 25 stocks that you could always, it's a go-to list. Okay, that's number one. Number two, familiarize yourself with the basic underlying stats of those stocks. So I can sit here and I can say to you, I can say to you, hey, you know what? Groupon's going to trade 27 million shares today. We can sit here and we can talk about all these different underlyings, and we'll kind of have a very good idea of what the volume should be under normal conditions, what the implied volatility should be under normal conditions, and by doing that, we also know what the expected move is going to be, and we know what the expected move is going to be on a daily basis and on an annual basis, so we can start to put some context around current prices. Again, all this does is shorten the time frame it takes, especially on smaller accounts, to make strategic trade decisions. So people say to me, well, okay, I've created a list of stocks. Now I'm watching what bid, ask, and net change.
Right.
It's got to be more than that.
Right.
And it doesn't have to be, you don't have to watch volatility tick for tick. You don't have to watch volume and open interest tick for tick. But if I pull up some underlying, like if I said to you, Tony, we're going to look at XRT today, for example, the retail index, we know right away that's not an incredibly liquid underlying, okay, for trading options. It has enough stock volume, maybe not enough option volume. Okay, if we look at something like we said FXI, which is the Chinese ETF, we know right away, hey, you're going to get 15 to 25 million shares of stock trading. You're going to get penny-wide markets in the options. You're going to get 23% implied volatility or 22% implied volatility. So you have some context before you actually.
That's kind of a wake-up call for me. Whenever I think of an ETF, I usually steer away from it, just because I haven't involved myself with them much. You normally just stick with individual stocks. But I've opened up my account now to looking at ETFs, and it's interesting that it uses that for a small account because of the liquidity. And you're wanting to find that liquidity in these larger ETFs. And so I need to get more familiar with those. And then I like what he says, because, especially with a small account and you're looking for stocks, you might have a clean slate and you're not used to any of the stocks. But you have to actually formally make a list of what you can trade and get to know the stocks or whatever it is. And you have a small account, it might just be a handful of them. So it's a great way to start, having a small account and doing these kind of trades and looking at this kind of watch list. So that's definitely going to be, for me, having a watch list there for whether it's each strategy or just having that clean list of of stocks that you can, or ETFs that you can use, looking through the existing watch lists that are on TastyTrade. I'm sure there's other YouTube channels too, but I usually just stick with what's on TastyTrade and search through what they've got on their watch lists and see what looks good to me and what I can use for my account. And then he says using single point strike stocks. There's some that are 5 points. Some that are even 10. So since you have a small account, you can't use much capital. Using the single point strikes is going to give you the best bang for your buck, because you can you have more wiggle room. Instead of doing $5 increments, it's $1.
actually doing it. And that's really important for smaller accounts because you don't have the luxury of doing something in, for example, in Apple or Google where the strikes are $5 or $10 wide, or SPX.
The stock is too high price.
Correct. And you'll also know things like ETFs, for example, like the Qs. You know, of course, there's plenty of volume in there, but you also want to have a good, decent idea about implied volatility and expected move. Let's go to the next one. Understand the concept of laddering. So what that means is if you have a limited amount of capital, you have to have a very clear concept of putting on enough. The number of occurrences has to get to you have to get to a certain number of occurrences in order to be successful. And it doesn't mean, hey, I'm going to be successful in January. January's been a tough month. Hey, I don't know if laddering by itself is going to make me successful. What I do know is I need to understand the concept of laddering even more so in a small account because I don't have enough capital or the flexibility to get this wrong. Okay, when you have a lot more capital and you're trading small, you can take a small hit. It's like driving a tank. Okay, you can bang into a garbage can and you can still be fine. Still going to drive. Right. Maybe you scratch the paint. If you're riding a bicycle, you bang into a garbage can. Okay, you're going over the top of it. Maybe that's a Chicago analogy, but that's where it's dangerous. So you need to understand the concept of laying out positions over time. You need to understand how to do things at different price levels and through different time intervals to give you enough diversification, but also to give yourself the right number of occurrences. All right, let's go to number 4. Also, you need to narrow down your strategies to 3 or 4 that you're very comfortable with. So we may start with 8 or 9 different strategies, but in the end, we need to get to 3 or 4 that we feel really good about.
Correct. And you're also going to be limited by the amount of cash you have also.
That's why. That's why. So you can't test 10 or 11 different strategies. You can't do 50 different things, okay? You're talking about a small account. You're better off with you need to have multiple strategies, but let's narrow it down to 3 or 4, okay? Because that's enough to work with. Correct. I'm trying to.
Now, you would never narrow it down to 1.
No, never.
Right.
I said 3 or 4. Let's try.
No, I know. I just want to make it, put it in.
As you can see here, I'm trying to create a set of mechanics, a process to deliver a set of mechanics so that when you're a lot more, when something's mechanical, you're more comfortable about it. Mm-hmm. Okay. If you have no idea, if you're about to hit a golf ball and you have no idea where it's going to go, okay, that's confusing and frustrating. If your mechanics are down, you have a pretty good idea where it's going to go. You don't know if you're a good golfer, but you have a pretty good idea where it's going to go.
Right.
Okay. Those are the first 4. Now, let's keep going. Number 5. You start with a limited buying power reduction number. Okay, this is very important. So the first thing you're going to do in your head is you're going to say, hey, you know what? I got $2,500. A reasonable buying power reduction number for me, maybe $250 a trade max. Okay, because what you're trying to do at this point is you're trying to say, I have to understand in my head when I set up a trade and I'm looking at the confirm and send button, I'm about to push this button. If I have a $5,000 account and this one trade is going to cost me $1,200, that's not going to work for me.
Right.
Okay, because that allows me 4 of those trades. So I have to figure out through time everything based on probability, based on buying power reduction. I have to start with a number in my head that I'm comfortable with. I don't know if that number is 100, 200, 300, 400, maybe even 500, depending on account size. But you know what? It's going to be a limited. I'm gonna define that up front so that I can stick to a concept of laddering and also reasonable buying power reduction expectations.
Makes sense.
Okay?
Sure. I mean, you said up to maybe even $500. I mean, I think $500 is a good number.
It just depends on how much capital you have. If you have $5,000,
you said a $5,000 account. I think
$5,000 to $10,000, of course it is.
Okay, good.
But what if it's a $3,000 account?
Then you can't.
That's
do
right.
5.
And what if it's a $4,000 account? Maybe you do a little bit more if you want to.
Sure.
Okay. All I'm saying is let's put a number in our heads so that, and it doesn't. You don't have to stick to it. But let's make this as
give yourself a guide.
If we can set the mechanics up in advance, we can create a universe of young, smart, aggressive, strategic investors that will feel comfortable with what they're doing because everything's mechanical. Number 6, focus on being conservative about delta risk and start to target a decay number even before you start trading, which means that, again, you're talking about reduction in cost basis by limiting profitability. In order to do that, you have to know your buying power reduction up front, and you also have to know you have to know both sides of the delta equation, just meaning that you kind of can put a directional risk to the trades that you're putting on, and you're starting to target a decay number. You're starting to figure out, hey, you know what? For every $1,000 in capital that I'm going to use, I may want to generate $5 a day in decay. Mm-hmm. $5 a day in decay on $1,000 in capital comes out to a monthly decay of just under $200, somewhere between $150 and $200. If I can start to manage that amount of decay and I start to understand how the whole process works, wow, I could be successful at this thing.
Sure. Number 5 and 6 also put away the myth that you can't be diversified and have more than 1 or 2 products with a small size account.
Exactly. Mm-hmm. And it also kills that whole current industry logic, which says got 20,000, spend 20,000.
Right.
Okay.
Today, meaning as soon as you bring in the check,
how much is that whole cake?
Right.
Okay. Got it. And this goes against things we believe. Like you and I would not walk into a great hamburger shop and say, "I will take 1/10 of that hamburger, please." Okay, that doesn't work.
No.
Okay, we want double that hamburger.
That's correct.
So this goes against things that we do in the other parts of our life. Number 7. And is this the last one? Okay, good. Set a minimum of trades to start with. In other words, we have to prove concept. And I'm all about number of occurrences. So my objective here with respect to number of occurrences is I need to prove concept. Okay, and the only way to prove concept is you set a minimum number of trades. So in other words, what I'm saying, Tony, is if you're just getting started using this kind of a philosophy, this kind of what I call functional logic, functional strategic logic, if you're just starting out, you can't give it one trade. It doesn't mean anything. Okay, you can't give it 5 trades or 10 trades, but we have to at least start somewhere. So let's set a minimum number of trades. Hey, you know what? Like what I'm telling my daughter, she's like, well, if I do this Groupon trade, like what she said to me is, if I do this Groupon trade, this is where do I start? I'm doing it with her at 2 o'clock in the afternoon with Case, and she's, if I do this Groupon trade and it works out, I'll do more. I'm like, no, that's not how it works. Okay, if you do the Groupon trade, then you do another trade, then you do another trade, another trade, another trade. We're going to do a minimum number of trades, and when we get that minimum trades, then you see if it works.
It can be an uphill battle for you.
I know, but that's how you prove concept. You can't prove concept with one trade.
One time, right?
Okay,
Just a 50-50 shot then.
okay, it's perfect, man. That was a very good segment today. We're going to take a short break. We're going to archive that. I hope you enjoy the Tasty Bites segment. Like I said, once a week for now. If we continue to get good feedback and we have extra slots, which we don't know if we have yet anyway, but if we have extra slots, we will try to slice it in there and
Continue with the small account theme. Yes.
Yep. Tell your friends, and the only place you can get TastyTrade, TastyTrade.com.
We'll be back in 90 seconds with our opening bell.
So yeah, with the number of occurrences again, he talks about when you trade small with a small account, you can generate more of those occurrences. And so that was something that I missed. For me starting out, especially at the beginning of this year, it was the wheel strategy. Just sell a put, let it get assigned. It was, that's pretty much the only strategy I knew starting out with options, and it was working well. And then you see this kind of approach where it's you're doing many different strategies on a very small scale and working on getting those occurrences. And here I did again. I need to save that tab. Let's see how quickly I can get there. So yeah, really interesting to see these kind of concepts, especially with a small account. And with me allocating, 10% of my account, I call it my R&D part of my portfolio. It's really just to find new things like this on a small scale that I can grow. So I feel like I've got a $2,500 account, finding these different kind of strategies and learning what works. The other part of my account is mainly doing the wheel strategy. I've got some of it in T-Flow, which is just basically sitting in cash, and I use also T-Flow for the wheel strategy whenever I sell a put. Any of the extra capital that I'm allowed to keep, I just put it into T-Flow until I get assigned on the put. So, and then I'm doing, I've got 20 shares of Tesla that I'm buying, just different things like that, buying and holding, which in the future I may take those shares and move them over to a different account where it's not affecting the net liquidation of my options account. Okay, we made it back. Not going to make that mistake again. Okay, is that going to work? Nope, I don't think that's going to work. We'll do it like that. Nope. I think that's going to do it.
Thomas, we're back, my friend. Tasty Bites.
All right, I'm behind.
Don't read it.
Huh?
Don't read the emails.
I'm behind. Yeah. Obviously, there are There are obviously
Comedy writers out there in the list.
No, there's obviously season 52 restaurants out there we just didn't know about.
Yeah, there's a few in Atlanta I've seen.
But
Florida.
Chicago's a really funny city in people.
Tough chain restaurant.
Yeah, it's not a chain restaurant city at all. It's even, I would say, almost New York has more. Maybe not. But it seems like when I go to New York, there's more kind of chains around. Chicago is just zero chain restaurant city. I mean, they just don't make it here.
Right.
And it is a very Midwestern, local. It's just not a chain city.
Melman's the closest to chain that we have.
Yeah, it doesn't. They just don't fly here.
Yep.
All right. I'm ready for my Tasty Bites, Mr. Bat. And I've got a ton of so much stuff going on today. So let's. Here we go. Let's do it, Linda. Now, I wrote this up. And again, just so we're clear on where we're going with Tasty Bites. Tasty Bites is for account sizes between, let's just say, 2,500 and 25,000, less than the pattern day trading minimum.
Correct.
And
which is 25,000.
Right.
If you have over $25,000 in your account, you maintain that balance, then you can.
Now, and remember, this has nothing to do with any specific brokerage firm. These are all kind of fin rules. They're not good rules. They're just rules. I mean, they're rules from.
They are what they are, right?
But they're rules from almost 15 years ago at this point, or 13 years ago. They make no sense anymore. They're actually a disincentive to success, but they haven't been changed yet because we have a serious lack of domain expertise in this business. I will say that accounts to do anything, you really have to have a margin account just to be able to trade the right products and things like that. Limited margin, IRA.
To get the number of occurrences you need, sure.
There are, but for smaller accounts, which we also have some of, there are two issues that you have to get over right away. One is there's a learning curve that you have to conquer. And some people have small accounts do not have a learning curve issue. But other people, hey, it's just getting started. I can understand that. You're not going to jump out there and play the hardest course or, do the craziest thing right away. There's a learning curve. Second thing is number of occurrences, which I can't stress enough because these are the two methods to getting to that level of success. One is conquering the learning curve. Again, with a small account, it's more difficult to conquer the learning curve. You have less room for error. Okay, you have a lower probability of success based on the amount of capital you have available. And
the strategies available.
Strategies available, capital available, and so that's why I put learning curve up here because I want you to understand the barrier for success is much more difficult with the smaller accounts. You have to be that much more committed. Okay, same thing with number of occurrences. One of the barriers to success is not getting to the right number of occurrences. And the problem that people make with a small account, and I've watched this. Listen, if I didn't watch this thousands of times, I don't think I would be qualified to say this, but I think I'm qualified to say this. The biggest problem is people say, okay, I'm going to give it a shot. Like my daughter, for example. Okay, Dad, I'm going to give this a shot. Okay, I'm going to try to learn this stuff. But the reality of it is, if she doesn't make money on her first 1, 2, or 3 trades, what if she started in January?
Right.
Okay, she'd be like,
going to lose interest.
This thing sucks.
I'll
never
knew
do
it
this
was
again.
this way.
Yeah. Yeah,
never trust your parents.
Yeah, and it works the first time when you go, listen, it's better that you didn't make money on the first trade type thing. But after the 7th or 8th trade, like at some point,
so much, sure.
At some point, you need to understand that you need to believe in the correlation and between number of occurrences and anticipated or expected success. And it is extremely difficult to get there with a small account size. Okay, let's go to the next one. So, two drivers of this: diversification and the strategy selection. When I talk about diversification, I'm actually talking about capital diversification, and I'm talking about capital diversification because that's the hardest hurdle to get over. And the second piece is strategies. Just I wrote the other day, limiting your strategies to 3 or 4, whatever it is, but at least understanding that there are multiple ways to get there. Okay, let's go to the next one. So week 1, and I'll take you through a couple steps here. And you might want to. This will all be archived,
of course.
But this is the crux of my discussion. This is the crux of my discussion for today. I just want to see how many. Okay, so I outlined a lot of stuff here.
Up to I.
Huh?
A, B, C, D, F, G, H,
I know.
I.
It may be too much for this single discussion, but I would like to squeeze it in. Got about 12 minutes left. I can squeeze this segment for about another 12
squeezing.
minutes. For number A, letter A, commit 20% of the allocated capital. Now, again, I'm just trying to set the groundwork. Well, if we have some time, either later today or next week, I'll look at some potential real trades. But I have to set the foundation. So I'm trying to take it a step further each week. So A, commit about 20% of the allocated capital. So let's say, Tony, your small account, $5,000. Right. Okay, you're talking about right out of the chute committing about $1,000 in capital. Correct. That's not to a single trade. That's about $1,000 in capital. If you have $2,500, okay, we're talking about committing $500. So my daughter's opening account with $2,500, or she opened an account with $2,500. So I'm going to ask her on week 1 to commit about 20% of her capital, and just so you understand, it's about $500. In a $10,000 account, okay, we're talking about $2,000. Okay, because the first thing you need is, well, what do I do?
Right.
And the first step is you commit a small amount of capital. I think 20% is a good number. Okay, and the reason for that is it gives you about 5 or 6 weeks worth of trading, taking positions on, taking positions off. I think it does enough. Second thing, week 1, commit to 5 trades, because I'm a freak about, remember, allocation. That's why I wrote up there, diversification, per capital diversification, and also strategic diversification. So I'm saying, and number of occurrences, commit to 5 trades. So you take 20% of the capital, again, on $2,500 account. So now I'm telling, like, even my daughter, okay, $2,500 account, 20% of the capital, it's $500, and then on that capital to commit to at least 5 trades. That's a lot, because that only limits her, because that's the absolute minimum you can get to.
Sure.
That limits her to $100 a trade. Okay, and I understand it. All right, I just want people to start putting some numbers together. Number C, I'm trying to stick around 4% to each trade. Okay, I'm just trying to put some numbers.
What do you mean by that?
So if the total capital is, okay, is, because I'm trying to
use
use
a number,
ways to
5,000, 2,500, whatever
okay,
you want to do.
So if you have a $2,500 account, okay, what's 4% of 2,500? It's $100 a trade.
Correct.
I'm just getting to different ways to get to that minimum number.
I got you.
Okay, so if you have a $10,000 account, it's like $400 per trade.
Gotcha.
What people ask me all the time is they're like, hey, you know what? Help me with the criteria here. Because what I've watched happen over the years is somebody will open up a $10,000 account. The first trade they'll make, okay, is $8,000, leaving $2,000 because they think that's what they're supposed to do.
Right, I got to get money to work.
I do it. Supersize me.
Right.
Okay, it's not that hard. That's our culture is, okay,
Yeah,
would
that's
you
me.
like,
Go big or go home.
well, you can leave a tip. You can leave 15%, 20%. Here in cabs right now, they do the whole thing. You can leave 15%, 20%, 25%, or 30%, let's just say. Okay, most people opt for like 25% because they don't want to seem cheap and they don't want, so they opt for much more than they would do if they were doing cash. It's the same thing with food. You see, you don't opt. When's the last time you said, I'll take the small? Okay, I was at some restaurant the other day and they said, would you like the small size? I'm like, no. Would you like a half a slab of ribs? No. Do you want a half a burrito? No. Okay, I'm suggesting that our culture is we opt for the larger size. We do the same thing when it comes to our capital. We want to make so much money so quickly in this thing, and if it doesn't work, we say we're done.
Right.
That's not the way. You can never be successful.
Rigged, right.
So these numbers all kind of come out the same. Commit 20% of capital, commit to 5 trades, commit approximately 4%, whichever way works out best for you. Right. So if you
You're
have,
talking about buying power now, right?
that's right, just buying power reduction. Right. So on a $5,000 account, it's like $200 per trade. On 25, that's all it is. Okay. C. Create an average of 1% positive decay per trade based on buying power reduction. This is all about limiting profitability and lowering cost basis. But in order to do that, you have to start thinking in terms, like I think you need to think in terms like we think, which is I know in the end that everything I do is going to work out a certain way. But people that are new don't know that. So when I say
Doesn't
this,
mean it's going to be profitable, right?
it does not mean it's going to be profitable. But when I say to my daughter, for example, okay, you need to create an average of 1% positive decay. Now she's got something that she can think about. So she's going to go back and go 1% positive decay. What does that mean on buying power reduction? So if my buying power, and that's per day, okay. So if my buying power reduction is $100, okay, that means I've got to create $1 in positive decay.
Correct.
Okay. So if my buying power, if I'm committing like 20% of my capital or 4% per trade or 5 different trades, and in the first week I'm going to commit $500. Okay, that means I'm
$5 a day.
$5 a day.
Theta decay.
Okay, that's not bad.
No.
Now that's an average.
Correct.
So it could be way less than that because on some trades it'll be less, especially when volatility is cheap. I couldn't get to a number lower than 1%. I'd be fine if it was a 0.5%. I'd be fine if it was 2%, whatever it is. What I'm suggesting is you have to have some number. You have to start somewhere.
Yeah.
That's the starting point.
Right.
Okay. E. Single point strikes, minimal number of strategies, low delta plays. So again, for week 1, and what this means is we're setting the foundation before we actually start getting to specific trades. So we're looking for, you want to trade the most liquid underlyings. You have to have single point strikes, especially for small accounts. When you first start out, minimal number of strategies. So just limit. Is it short puts? Is it a covered call? Is it a vertical spread? Is it a credit spread? You kind of know now, what kind of theta you're trying to create, what kind of decay you're trying to create, what kind of deltas, the whole shebang. Okay, minimal number of strategies, and a low delta play just means, hey, you know what?
It takes a direction out of the trade.
It's okay to have direction.
Strategies.
It's okay.
Yes.
You can be directional. You're bearish here. You're bullish. Whatever it is, it's fine to be directional. Just keep it small.
Right.
Okay.
Learn the
Define
strategies.
F. Define max profitability and set reasonable expectations.
See, and I think that's a big point for me there. I tend to be on the bullish side. It's hard for me to be bearish, just from investing and just my overall bias. It's bullish because, I believe that, the stock market is long-term historically gone up. So I have that natural bias to believe that in the long term, everything's going up when in fact I need to be neutral as an options trader and to have a lean one way or the other. But to think of a way where I can benefit when the stock goes down, it's a new concept for me. So I've got to be able to change my thinking and my thoughts that I can make money going short. And so I've sold some calls on my call spread and strategy. And so I've made some money on that. I think that's going to help as I start seeing that I can make money as the stock goes down. I can start trusting those call spreads as much as I can, a put spread or whatever strategy it is, to be comfortable just being neutral.
So the reason you define max profitability here is because by defining max profitability, you're setting yourself up with a certain type of trade that will also define your capital. Okay, it will start to get you to understand the terminology around profitability, probability, expectations. Okay, again, remember I shouldn't say this. One of the single biggest problems with consumers who try to invest on their own, self-directed consumers, is that the expectations are either get rich or have somebody else do it. Okay, we do not have those same expectations. We don't walk into a bank and say, make me rich. Okay, we walk into a bank because we don't need somebody else to act as a intermediary to our banking services. Sure. But we will walk into the investment side of the business, the let's call personal finance.
I need to get rich yesterday.
That's right. That's right.
Yeah, I got you.
Yeah.
Right.
Yeah. I remember
not like that.
I remember somebody once asking me, and they said, "Can you just put this in easier terms for me? What trade should I put on if I want to buy a pickup truck?"
Right.
I'll never forget that.
Hey, listen, my own father did it to me. I mean, I'd saved money for 3 years in Chicago, and I tried to save $5,000 to start trading, and he called me up about a month into my trading. I'm struggling, just trying to make a couple of bucks. He said, "Hey, son, if I give you 50 grand, can you make it 100 in 6 months?" I said, 50 grand? It took me 3 years to save $5 grand. You want to give me 50 and turn it into 100? People want to do that.
It's crazy. We don't set reasonable expectations. One of the reasons we do that is because we don't define max profitability. Right. As soon as you define max profitability, as soon as you say to me, I'll give you the example with your dad. Mm-hmm. As soon as you say to your dad, listen, give me 50 grand, maybe I can get you back 55. Then all of a sudden you've set max profitability and reasonable expectations. And now,
well, it took me 3 years to have that conversation with him because I didn't talk to him again for 3 years.
But my point is, and next time he doesn't ask you.
That's correct.
Because he has reasonable expectations. But that's how you have to do it, because we have to change culture. Let's go. G. Mm-hmm. So you have to give yourself a minimum commitment of 3, 4, 6 weeks, whatever it is. I wrote minimum 3 to 4 weeks. Okay, which means the duration,
your trade duration.
Your trade duration needs to be 3 to 4 weeks at an absolute minimum. But you also have to give yourself 3 to 4 weeks. Okay, because you have to continue the process. But the minimum trade duration, 3 to 4 weeks, because this cannot be an overnight sensation. It doesn't help either. Let's go. Stay in liquid underlyings. That goes without saying. And
that one gets violated a lot. People find stocks with high volatilities that don't have any option volume in there, and they'll be all in that one stock, and then it doesn't work out well.
Okay, and the next one is give trade examples. So here's where I want to leave off on this, Tony, and pick this one up next week. I thought if we had time, we could start to get into the first couple of trades, but I'm now that I'm seeing timing and everything else, I don't want to start getting into all the trades. I'd rather wait for next week. I just wanted to kind of outline, but next week. Okay, next Wednesday.
Those who are playing at home, they can find their own too.
Of course. Mm-hmm. Next Wednesday, we will start to get into specific trade examples, because now I've set the foundation. I've done
They say they're going to do trade examples, but that actually happens.
Now what I want to do next week
I think in a few more episodes, I think they put it off.
Using a certain list
they
of
do
stocks,
give some examples of what they do, and it's helpful.
Using some of those stocks and starting to create, because I think once you give examples, it really puts a lot of perspective.
Put the bow on it. Absolutely.
Yeah, I'm going to use like an account size somewhere in the middle, probably maybe $5,000 to make the most sense, and we will start to put in just some very small trade examples. Now, what I did was to take this to the next level. I created a blank account. So I'm going to do this right alongside. Okay. So I created a blank account. I'm going to start putting the same kind of positions on that we talk here, and I'm going to do it just side by side. And because I want to show the mentality of, hey, you know what? Here's 5 trades first week. Here's about 4% of buying power reduction each trade. Here's 20% of my total capital. Blah blah blah.
1%.
That's exactly right.
Got it.
Trying to create the right number of decay, and we'll start that on next Wednesday at 8 o'clock.
8 o'clock, correct.
All right.
IBM's up, similarly quoting that because we have earnings play in there, and Google's up $34. So expected move in Google was right there at around $32, $33. IBM is actually better. It's expected moves around $5.5 at 7.
Cool.
Yep.
Take a short break. Come on back to opening bell.
All right, some good stuff. I'm going to try and keep these live streams within an hour here. So we're about to wrap up here. Looks like we got 3 episodes in. We got the beginning, 3 videos. And really just to kind of recap what we've gone through and what they're talking about here is using defined risk strategy, being diversified strategically, right? Have different strategies on a small section. And they even did that with a $2,500 account back then to have different strategies. And don't aim for home runs. A set amount of capital per trade. The number of occurrences is important to prove your strategy and your mindset too, right? You need to be in liquid stocks, single point strikes, looking at ETFs and inverse ETFs, getting used to those in your watch list that you make, and having that watch list and learning that watch list. One of the videos that he brings up is, one of the points he brings up is to don't focus so much on your P&L, focus on your market awareness, focus on the watch list that you have and get to know that and understand the opportunities that lie in there. And so the way I think of it in my head is that you have these strategies that you can fire off that you know fit a certain criteria in the market. And whenever you see those opportunities lay out in these watch lists, you can start playing those trades out. So that's, I think, whenever you learn that strategy and get familiar with that strategy, you can learn to apply those as the opportunities present themselves in the watch list that you make. So having that watch list is really important to be able to make the trades, the trade commitment that you're looking to do. So familiarizing yourself with the stats. He mentions volume, volatility, expected move, and he mentions open interest in there as well. And I'm sure the options prices that ties in with volatility and all those other things that fall under that. Understanding the concept of laddering, which I'm imagining, the way that I see laddering is doing different time frames. Having the narrow strategies there, 3 or 4 for your small account. Limit the buying power reduction number. So I think they had $100 they were doing for their $2,500 account, I believe. So conservative delta risk, which I tend to be bullish on delta risk, and so I have to be mindful of being neutral. And then having a target theta number. So that's kind of new to me. I think I've been noticing in my account it's been around like 25, and that includes the wheel strategy and all those different strategies that I'm doing. So, and the stocks that I own. And so I really want to be able to focus on that number on my portfolio with options. And I think having shares of stock in there might, I don't know how it messes with that number exactly, but I wonder that if I need to just take those stocks and set them aside in my cash account. Minimum number of trades for proof of concept. That's the number of occurrences. We're going to be going through a learning curve with new strategies, so getting past that as fast as you can. And that's what I want to do with these TastyBites, is to understand more of these strategies. And so increase your number of occurrences. And then they said drive diversification of your capital, and doing those strategies are the two drivers for getting over the learning curve and getting those number of occurrences. And then we just watched, the 8 points here for that account. So really, for your own account, and this, I guess, is homework for me and you too, if you have a small account and you're wanting to learn and follow along, how much can you commit for your small account? They put 20% there. How many trades can you commit? They have 4% per trade, and they're doing all this on a $2,500 account. Looking for 1% positive decay. What does that look like on your account? And that's based on the buying power reduction. So they look at that on I guess you could look at it maybe on a trade by trade basis, or maybe a strategy by strategy basis, or if your portfolio for that matter, depending on the different strategies you've got. Single point strikes, again, he mentions that. So a number of times they mentioned doing single point strikes. And then minimal number of strategies, low delta plays, define max profitability and reasonable expectations, not trying to hit the home runs. What can you reasonably achieve if you're expected to win, 80% of the time, lose 20% of the time? How much do you lose when you lose? How much do you win when you win? And add those together and see what you can expect to make with that. So they're looking for 3 to 4 trades, or it's going to be 3 to 4 weeks duration per trade. it's not a, it's not a day trade thing here. It's a letting time work out. And a lot of my credit spreads are that way. Some of them I did some call spreads and they got filled 50% profit in a day's time. So it can happen frequently, but sometimes they take time. So I've still got positions that I've had for a few weeks now, still open. Staying in liquid underlyings because the spreads widen out and it can take away your profits. So liquidity is really important. And again, they mention that I think in every video. So got those things, got a little bit of homework there to look at and really apply these concepts to your account, to your strategies. And then as we go along, you'll start seeing more of these strategies play out, and they have studies to back up which strategy is best given certain conditions. So that's what we got to look forward to next time. I might go live tomorrow, so you'll just keep an eye out for that if you want to join. And we'll just keep doing this and progressing along through these Tasty Bites in the R&D room live. So we'll see you guys next time. Thanks for joining.